New York, October 1907. The lights of Wall Street flicker like a dying candle. Banks are failing. Factories shut down. Panic spreads like fire through telegraph wires. There is no Federal Reserve, no government bailout, no plan. In the middle of it all stands one man, John Pierpont Morgan, 69 years old, racked by rosacea and exhaustion, yet somehow the only person America still trusts. While the nation holds its breath, he locks New York's most powerful men inside his library and tells them, "Gentlemen, you are not leaving until we save the country." This is the story of the night a banker did the impossible, and in doing so, changed the way the world works forever. America, in 1907, wore its wealth like armor. Electric streetlights had replaced gas lamps in Manhattan. Steel skyscrapers clawed at the sky. Automobiles coughed their way down cobblestone streets, while horses still outnumbered them 10-1. The Gilded Age wasn't just a metaphor. It was a promise etched in marble and gold leaf across every bank facade from Wall Street to Market Street. But beneath the gilt, the wood was rotting. The financial system of turn-of-the-century America was a magnificent house of cards. There was no central bank, no lender of last resort, no coordinated monetary policy, just hundreds of independent banks, dozens of trust companies, and a Treasury Department that could do little more than watch and hope. Money was oxygen, and the entire country was breathing through a straw. Trust companies, the shadow banks of their era, had proliferated like wildflowers in spring. They promised higher returns than traditional banks. They invested in railroads, copper mines, real estate schemes, anything that gleamed with speculative promise. And Americans, drunk on the prosperity of a growing industrial empire, poured their savings into them. By October 1907, the straw had nearly bent to breaking. It began, as these things often do, with hubris and desperation. Two men, Augustus Heinze and Charles W. Morse, had been playing a dangerous game. They'd been buying up shares in their own banks, using those shares as collateral to buy more shares, building a pyramid of debt that could only stand if stock prices kept climbing. It was a scheme as old as greed itself, and just as doomed. On October 14th, their scheme collapsed. The stock market shuttered. Banks connected to Heinze and Morse teetered. Depositors, that most skittish of creatures, began to worry. Then came the Knickerbocker Trust Company. The Knickerbocker was no small operation. It was one of New York's largest trust companies, holding deposits worth $62 million, nearly $2 billion in today's money. Its president, Charles Barney, was a socialite, a man of refined tastes and expensive habits. He was also, it turned out, connected to the Heinze-Morse debacle. The rumors started on a Monday. By Tuesday, they were whispers in every drawing room. By Wednesday, they were headlines. Knickerbocker Trust in danger. Thursday, October 17th, 1907. Dawn broke over New York City to reveal something that would haunt the American imagination for decades. A bank run. The line started forming at 6 in the morning, 3 hours before the Knickerbocker's doors would open. Clerks, shopkeepers, widows, immigrants, people who'd saved every penny, who'd trusted the marble columns and the gold lettering and the promise of American prosperity. They stood in the autumn cold, breath misting, fear etched in every face. By the time the doors opened at 9, the line stretched around the block. Inside, tellers worked with mechanical precision, counting out bills and coins with shaking fingers. The vault, that supposedly impregnable fortress, began to empty. By noon, $8 million had walked out the door. By 1 o'clock, Charles Barney had been forced to resign. By 3 o'clock, the Knickerbocker Trust Company suspended operations. It was out of money. The news spread through New York like cholera. If the Knickerbocker could fail, any bank could fail. Every bank could fail. By Friday morning, lines had formed at a dozen other institutions, the Trust Company of America, the Lincoln Trust. Even the venerable Bank of North America saw depositors demanding their cash. The panic wasn't spreading. It was metastasizing. Telegraph operators worked overtime, sending urgent messages to Chicago, Philadelphia, Boston. The crisis in New York was becoming a national catastrophe. In Pittsburgh, steelworkers found themselves without wages when their employer's bank closed. In San Francisco, still recovering from the 1906 earthquake, credit evaporated overnight. Across the country, factories began laying off workers, not because demand had fallen, not because they were unprofitable, but because they couldn't access cash to pay for raw materials or meet payroll. The machine was seizing up. In Washington, President Theodore Roosevelt paced the halls of the White House like a caged lion, the great trust buster, the man who'd made his reputation breaking up monopolies and reining in corporate power, found himself utterly helpless. The federal government in 1907 had no tools to fight a financial panic. The Treasury could deposit government funds in struggling banks, but Treasury Secretary George Cortelyou had already done that, pouring $25 million into New York banks. It hadn't been enough. It was like throwing a cup of water on a house fire. Roosevelt knew what was needed. Someone had to coordinate the rescue. Someone had to force the healthy banks to support the sick ones. Someone had to create liquidity out of thin air to inject confidence into a system choking on fear. The problem was simple and devastating, that someone couldn't be the government. Congress wasn't in session. There was no mechanism for emergency action. And even if there had been, the American public, still deeply suspicious of centralized financial power, would have revolted at the sight of Washington taking control of the nation's banks. On October 21st, Roosevelt made a telephone call. It was brief, almost perfunctory, but it acknowledged a remarkable truth. The President of the United States was asking a private citizen for help. The man he called was 70 miles north, in his estate overlooking the Hudson River, John Pierpont Morgan. J.P. Morgan should have been enjoying his autumn years. At 69, he'd already lived 3 lifetimes of achievement. He'd financed railroads that stitched the continent together. He'd created U.S. Steel, the world's first billion-dollar corporation. He'd bailed out the U.S. Treasury during the Panic of 1893, organizing a private syndicate to provide gold reserves when the government couldn't. He was, by any measure, the most powerful private banker in the world. But power had come at a cost. His face, disfigured by rhinophyma, a condition that left his nose swollen and discolored, made him self-conscious in public. He was gruff, imperious, prone to volcanic rages and long, brooding silences. He collected art with the passion of a Renaissance prince and played solitaire to calm his nerves. He was deeply religious, reading the Bible every night, convinced that wealth carried moral obligation. When Roosevelt's call came, Morgan was tired. He'd been planning to stay at his Hudson Valley estate through the autumn, away from the chaos of Wall Street. He'd earned his rest. But when he heard the words national crisis, something in him stirred, the old warhorse hearing distant drums. He took the train to New York that evening. As his private car rolled south through the October darkness, Morgan stared out at the scattered lights of towns passing by. He knew what awaited him. The panic was accelerating. By the time he reached Manhattan, another day of bank runs would have drained millions more from the system. The Trust Company of America, one of the largest in the city, was on the verge of collapse. If it fell, it would take down dozens of smaller institutions with it. The mathematics were brutal. There simply wasn't enough cash in New York to satisfy every depositor who wanted their money back. Bank reserves were meant to cover normal withdrawals, not mass panic. The system was built on trust, the faith that not everyone would demand their money at the same time. That faith was dying. Morgan arrived at Grand Central Terminal just after midnight. A car was waiting. As it carried him through the empty streets of Manhattan, he could see the evidence of economic paralysis. Darkened storefronts, newspaper boys sleeping on corners, clutching tomorrow's headlines about disaster. A city holding its breath. The car pulled up to 219 Madison Avenue, Morgan's library, a Renaissance palazzo he'd built to house his collection of rare books and manuscripts. But tonight, it would serve a different purpose. Tonight, it would become the command center for saving, American capitalism. To understand what J.P. Morgan was about to attempt, you have to understand the man himself, not the legend, not the caricature of the greedy banker, but the actual human being with all his contradictions. Morgan believed in hierarchy. He believed that society needed leaders, that expertise and experience mattered, that democracy in financial matters was a recipe for disaster. He was, in modern terms, a technocrat with authoritarian instincts. He thought he knew better than others because often he did, but he also believed in duty. This was a man who'd grown up Episcopalian, who saw wealth as a stewardship rather than a prize. He believed, genuinely believed, that those who'd been given much had an obligation to give back, not through charity alone, though he was generous with museums and churches, but through action, through using your power when the moment demanded it. The night of October 21st was such a moment. Morgan's library became something between a war room and a confessional. He summoned the presidents of New York's major banks, James Stillman of National City Bank, George F. Baker of First National, Frank Vanderlip, Henry Davison, names that meant nothing to the average American but represented the commanding heights of finance. They gathered in the East Room, beneath frescoed ceilings and surrounded by illuminated manuscripts worth millions. The incongruity was striking. These men in their severe black suits, smelling of tobacco and anxiety, surrounded by the glories of European civilization. Morgan laid out the situation with characteristic bluntness. The Trust Company of America will fail tomorrow unless we act. When it fails, it will trigger a cascade. Lincoln Trust will go next, then Metropolitan, then God knows how many others. Within a week, there won't be a functioning bank in New York. Someone, accounts differ on who, asked the obvious question. What can we do? We can't cover every depositor. There isn't that much money in all of New York. Morgan's eyes, sharp despite his age, swept the room. We don't need to cover every depositor. We need to create confidence. We need to make people believe the money is there. It was a psychological insight wrapped in financial mechanics. Bank runs feed on fear. Stop the fear, stop the run. But how do you stop fear when it's already metastasizing through the streets? Morgan's answer was audacious. Coordinate everything. What Morgan proposed was simple in concept, but nearly impossible in execution. He would personally organize and direct a private rescue of the entire American financial system. He would determine which institutions could be saved and which had to fail. He would decide how much money each bank would contribute. He would force competitors to cooperate. He would, in effect, become a one-man central bank. The very thing America had rejected since Andrew Jackson killed the second Bank of the United States 70 years earlier. The plan had several components, each as delicate as defusing a bomb. First, the healthy banks would pool resources to create a massive emergency fund. This money would be lent to sound but illiquid institutions, banks that had good assets but not enough cash to meet immediate withdrawal demands. Second, Morgan would personally examine the books of every struggling institution. He'd decide which ones were fundamentally solvent and which were genuinely insolvent. The solvent would get support. The insolvent would be allowed to fail, but in an orderly way that minimized contagion. Third, he'd use his personal credibility, the trust that his name commanded, to signal to the market which institutions were safe. Morgan's backing would be worth more than gold. Fourth, and most audaciously, he'd coordinate with the clearinghouses, the organizations that settled transactions between banks, to issue emergency certificates. These weren't quite money and weren't quite IOUs. They were a form of scrip that banks could use to settle debts with each other, freeing up actual cash for depositors. It was brilliant, it was desperate, and it relied entirely on Morgan's ability to command respect, instill discipline, and make life or death decisions with imperfect information under impossible time pressure. You're asking us to trust you, Stillman said. It wasn't quite a question. No, Morgan replied. I'm asking you to trust mathematics. The system has enough assets to survive. It just doesn't have enough cash in the right places at the right time. We're going to fix that. But there was a subtext everyone in the room understood. Morgan was also asking them to trust him, to let him play God with their institutions, to accept his verdicts about who lived and who died. Not everyone was on board. Some of the bankers were rivals who'd spent years trying to undercut each other. The idea of cooperating, of sharing confidential information about their reserves, was anathema. Others were simply scared, terrified that if they committed funds to the rescue and it failed anyway, they'd destroy their own institutions. One banker, a younger man who'd inherited his position rather than earning it, stood up and declared, "This is madness. We'd be throwing money into a black hole. The Trust Company of America is finished. Why should we go down with it?" Morgan's response was swift and cold. Because if it goes down alone, you'll go down with it anyway. The only question is whether you fall separately or survive together. The room fell silent. Morgan stood, walked to a side table, and poured himself a glass of brandy. He didn't offer anyone else a drink, a deliberate slight. a power play. He sipped slowly, letting the silence stretch until it became uncomfortable. Then he said, "Gentlemen, I'm 69 years old. I don't need this. I could be at home. I could watch New York burn from a distance, but I'll be damned if I let this system collapse, because you're too afraid or too proud to do what's necessary." He set down his glass with a sharp click. "You have two choices. You can join me, and we save what can be saved. Or you can refuse, and explain to your depositors tomorrow why you chose pride over survival." It was classic Morgan. Part logic, part intimidation, part moral suasion. He wasn't asking, he wasn't pleading. He was simply stating reality and daring them to reject it. One by one, they agreed. While Morgan and the bankers strategized in the warmth of the library, outside, the human toll mounted. In the Lower East Side, a clerk named Samuel Levy stood in his small apartment, staring at a bank book that had become worthless paper. The Knickerbocker had held his life savings, $340 earned over 8 years of 12-hour days. Now it was gone. He had a wife, 2 children, rent due on Friday. Multiply Samuel by thousands, tens of thousands. People who'd played by the rules, who'd saved instead of spent, who'd trusted in the system. Now they were learning that trust was a luxury they couldn't afford. Reporters prowled the streets, capturing testimonies of disaster. A widow who'd lost her husband's death benefit. A shopkeeper who couldn't make payroll, watching his employees walk away into an economy with no jobs. An immigrant who'd been 3 months away from bringing his family from Italy. His ticket money now trapped behind the locked doors of a failed trust company. These weren't abstractions to Morgan. He knew, intellectually if not emotionally, that every hour he delayed, more families slid toward destitution. The weight of it settled on him like a physical burden. His rosacea flared worse than usual. His hands trembled slightly when he thought no one was watching. But he also knew that sentiment without strategy was useless. You couldn't feel your way out of a financial crisis. You had to think. By midnight on October 21st, Morgan's team had assembled. Beyond the bank presidents, he'd summoned accountants, lawyers, messengers. The library transformed into something resembling a military headquarters during wartime. Clerks spread ledgers across tables. Telephone lines were commandeered. Messengers ran between the library and nearby banks, bringing updated figures on reserves, withdrawals, available assets. Morgan himself moved through it all like a gray battleship, absorbing information, issuing orders, making decisions that would reshape the financial landscape. The first priority was the Trust Company of America. Benjamin Strong, a rising banker who'd later become the first governor of the Federal Reserve Bank of New York, was dispatched to examine the trust's books. He worked through the night, adding columns of figures by gaslight, trying to determine if the institution was fundamentally sound or rotten. At 3 a.m., Strong returned with his verdict: salvageable. The Trust Company of America had good assets, mortgages, bonds, loans that would pay off. It just didn't have enough cash to survive tomorrow's expected withdrawals. Morgan asked the critical question: how much? 5 million, maybe 8 to be safe. It was an enormous sum, but Morgan had anticipated worse. He turned to Stillman and Baker. Can National City and First National each put up 2 million tomorrow? They hesitated, not because they didn't have it, but because committing it would reduce their own reserves. If the panic worsened, they'd be vulnerable. Morgan didn't wait for an answer. You can, and you will. I'll cover the remainder personally if necessary. It was the kind of autocratic decision that would later fuel calls for government regulation. But in that moment, it worked. The 2 bankers nodded. The rescue package for the Trust Company of America was assembled. But the night was far from over. Around 4 a.m., a new problem emerged. The clearinghouses, the organizations that processed checks and settled accounts between banks, were on the verge of collapse. Banks were refusing to accept each other's checks, terrified that the issuing institution might fail before the check could be presented. Without functioning clearinghouses, the entire payment system would freeze. It wouldn't matter how much money was in any bank if transactions couldn't be processed. Morgan's solution was radical: issue clearinghouse certificates. These were essentially IOUs backed by the collective credit of all participating banks. They weren't legal tender, but they could be used to settle interbank obligations, freeing up cash for depositors. The problem was getting the banks to agree. Issuing clearinghouse certificates required unanimous consent. And unanimity at 4 a.m. among exhausted and frightened men was almost impossible. This is where Morgan's personality became crucial. He didn't cajole. He didn't compromise. He simply made it clear that dissent wasn't an option. "The certificates will be issued," he said. "The only question is whether you want your name on the list of banks that saved New York or on the list of cowards who let it burn." It was bullying. It was manipulation. It was also effective. By dawn on October 22nd, the clearinghouse certificates were authorized. The payment system would continue functioning. One crisis averted, but the biggest battle still lay ahead. October 23rd, 1907. The sun rose on a city that still teetered on the edge. The rescue package for the Trust Company of America had been announced. Depositors who'd been lining up since before dawn learned that the trust had secured support from other banks. Some left the line. Many stayed, unconvinced, determined to get their money while they still could. At 219 Madison Avenue, Morgan's library had become something between a command center and a prison. The mahogany doors stayed locked. Guards, hired by Morgan personally, stood watch. No one entered without permission. No one left without Morgan's explicit approval. The phone lines were monitored. Even the messengers who carried information between the library and the financial district were carefully selected for loyalty and discretion. Inside, the atmosphere was thick with cigar smoke, coffee fumes, and the acrid smell of fear. Men who normally slept on silk sheets were catching catnaps on leather chairs. Clerks worked with ink-stained fingers, their handwriting growing shaky from exhaustion. The accountant's eyes were red-rimmed, straining to read figures by gaslight and the weak autumn sun filtering through stained glass windows. Morgan himself looked like death. His face was gray, his famous nose even more inflamed than usual. He'd been awake for nearly 48 hours, sustained by coffee, brandy, and what can only be described as sheer willpower. But there was no time to rest, because on October 23rd, a new crisis erupted, one that threatened to undo everything they had accomplished. At 1:30 p.m., a messenger burst into the library with news that made even Morgan's iron composure crack slightly. The New York Stock Exchange was about to collapse. Not figuratively, literally collapse. Several major brokerage firms were on the verge of bankruptcy. They'd borrowed heavily to finance their customers' stock purchases, a practice called buying on margin. When stock prices fell during the panic, these loans became unpayable. Now the brokerages were failing, and if they did, they'd have to dump their entire stock portfolios onto the market at once. The result would be catastrophic. Stock prices would crater. That would trigger more margin calls, more forced sales. A death spiral that would wipe out billions in wealth and probably take down several major banks that had lent money to the brokerages. The president of the stock exchange, Ransom Thomas, had sent the message. Unless someone could provide $25 million in emergency loans to the brokerages in the next 15 minutes, he would close the exchange, possibly forever. 15 minutes. Morgan looked at the clock. 1:32 p.m. Around him, the room erupted in chaos. Bank presidents shouting, accountants scrambling to calculate available reserves, lawyers debating whether such loans would even be legal. Morgan raised one hand. Silence fell. "How much do we have available right now? Between all of us?" The answer came back. Maybe $15 million at most. And that was assuming every bank committed everything they could spare. Not enough. Not nearly enough. 1:35 p.m. Morgan made a decision that revealed both his genius and his ruthlessness. He sent word to Thomas, "Keep the exchange open. The money is coming." Then he turned to the assembled bankers and said, "We're about to find $10 million doesn't exist." What Morgan did next was financial alchemy of the highest order. He had Davison and Strong start making calls to every major financial institution within reach. Not just banks, insurance companies, trusts, even wealthy individual investors, anyone with liquid capital. While they worked, the phones, Morgan himself drafted a document. It was a guarantee, signed by him personally and co-signed by the major banks present, promising to backstop any losses from the emergency loans to the brokerages. In essence, Morgan was using his personal credibility as collateral. He was betting that his name, his reputation, his 40 years of financial success was worth $10 million 1:40 p.m. The pledges started coming in. $2 million from an insurance company, $1.5 million from a railroad magnate who owed Morgan a favor, $3 million cobbled together from smaller banks. Still not enough. 1:43 p.m. Morgan looked at Baker and Stillman. "You're each going to commit another $2 million. We already committed everything we can spare," Baker protested. "No, you committed everything you're comfortable committing. Now you're going to commit everything you possibly can. Move money from reserves, call in loans. I don't care how you do it. Find $2 million each." The room went silent. What Morgan was asking was dangerous. If the rescue failed, National City and First National would be severely weakened, possibly fatally. But Morgan's gaze was unrelenting. This was the moment. This was where salvation was won or lost. 1:46 p.m. Baker and Stillman looked at each other. Some unspoken communication passed between them. Then they nodded. Done. Morgan immediately sent a runner to the stock exchange with a message. "The money is on its way. Do not close." The runner sprinted the 6 blocks to Wall Street. At 1:47 p.m., he burst onto the trading floor and delivered the message to Thomas. The exchange stayed open. At the closing bell, at 3 p.m., it was still functioning. Brokerage firms that had been minutes from bankruptcy had received their emergency loans. Stock prices stabilized. The death spiral had been averted, but the victory was temporary and everyone knew it, because while Morgan had saved the stock exchange, the underlying panic hadn't subsided. Banks were still under siege. The Trust Company of America, despite its rescue package, was still hemorrhaging deposits. And new problems were emerging every hour. The night of October 23rd would test them all to the breaking point. At 7 p.m., Morgan called for another meeting. The same men who'd been working in the library for 3 days returned, some having gone home briefly to wash and change, most looking like they'd just crawled through a disaster zone. Morgan had news, and none of it was good. Another major trust company, Moore & Schley, was about to fail. Unlike the Trust Company of America, this one was genuinely insolvent. Its assets were worth less than its debts. It couldn't be saved, but it also couldn't be allowed to fail in a disorderly way. Moore & Schley held significant shares in Tennessee Coal and Iron Company, TC&I. If Moore & Schley collapsed, those shares would flood the market, crashing TC&I's stock price and triggering more margin calls and failures. Morgan had a solution. U.S. Steel, the corporation he'd created in 1901, would buy TC&I. This would stabilize TC&I's stock price, give Moore & Schley enough value to meet its obligations, and prevent a disorderly collapse. There was just one problem. Such a purchase might violate antitrust laws. U.S. Steel was already the dominant force in American steel production. Adding TC&I would make it even more powerful. Morgan would need approval from President Roosevelt himself. At 10 p.m., Morgan's men reached Roosevelt by telephone at the White House. They explained the situation. Roosevelt, to his credit, understood immediately. He promised that the government wouldn't oppose the acquisition. Crisis number 17 resolved. But crisis number 18 was already emerging. Midnight. October 24th, 1907. Morgan sat alone in his private study within the library. He'd sent the others to rest, though he knew most would just collapse into chairs in the East Room rather than go home. He was exhausted beyond measure. His hands shook as he poured another brandy. His vision blurred at the edges. He was 69 years old, and he'd been working essentially nonstop for 4 days. But something else was weighing on him, something heavier than exhaustion. He'd been making life or death decisions for thousands of people, millions if you counted all those affected by the broader economy. He'd decided which banks lived and which died, which depositors would get their money and which would lose everything. He'd become, effectively, the economic dictator of the United States. And the worst part? It was working. The system was stabilizing. The panic was beginning to ebb. His impossible idea was succeeding. But at what cost? Morgan opened his Bible, a worn leather-bound copy he carried everywhere. He read from Job, about suffering and faith, and the burden of being chosen for difficult tasks. He found no comfort there, only a reminder that duty was its own reward and its own punishment. A knock at the door. Davison entered, looking nearly as bad as Morgan felt. "Sir, the Trust Company of America. Withdrawals are finally slowing. We think it's going to make it." Morgan nodded. "And the others?" "Lincoln Trust is stable. Metropolitan is holding. The smaller institutions, some will fail. But it won't be a cascade. We've contained it. Contained it. Past tense. They'd actually done it." Morgan should have felt triumph. Instead, he felt only a vast weariness. "Gather everyone," he said. "We have one more piece of business tonight." At 2 a.m. on October 24th, the presidents of New York's major trust companies assembled in Morgan's library. These weren't the commercial banks. Those had already been stabilized. These were the riskier, less regulated institutions that had been at the center of the panic. They were exhausted. They were scared. And they were, many of them, still in denial about how close they'd come to total annihilation. Morgan looked at them with something approaching contempt. "Gentlemen," he said, "we've spent 4 days saving you from yourselves. We've committed hundreds of millions of dollars. We've moved heaven and earth. And now, I'm going to tell you what you're going to do next." He slid a document across the table. It was a pledge. Each trust company would commit to maintaining higher reserves going forward. They'd submit to regular examinations. They'd coordinate their lending to prevent the kind of speculative bubbles that had triggered this crisis. In short, they'd accept regulation. Not from the government, but from Morgan himself and the clearinghouse associations. Some of the trust presidents objected immediately. This was overreach. This was autocracy. Who was Morgan to dictate terms? Morgan's response was to stand up, walk to the door, and lock it. The click of the lock echoed in the sudden silence. "You're not leaving," Morgan said, "until every one of you signs that document. I don't care if it takes an hour or a week. The doors stay locked until this is done." It was the most naked display of power anyone in the room had ever witnessed. Morgan wasn't threatening. He wasn't negotiating. He was simply imposing his will through sheer force of personality. One trust president, a younger man named Thorne, stood up angrily. "You can't keep us here. This is kidnapping." Morgan's eyes, bloodshot and terrible, fixed on him. "Try to leave. See what happens when the morning papers report that you refuse to help stabilize the system. See how many depositors show up at your doors tomorrow." Thorne sat down. For 3 hours, they sat in the locked room. Some argued, some pleaded, some sat in sullen silence. Morgan, for his part, ignored them all. He sat in a corner, playing solitaire, occasionally glancing up to see if anyone had approached the document. At 4:30 a.m., the first signature appeared, then another. Then, like a dam breaking, they all signed. Morgan unlocked the door at 5 a.m., just as the first light of dawn was touching the stained glass windows. "Gentlemen," he said, "the crisis is over. Go home." They stumbled out into the morning, blinking like miners emerging from a collapsed shaft. Behind them, Morgan closed the door and leaned against it, suddenly looking every year of his age. It was over. The panic of 1907 had been contained. America had been saved from total collapse, and J.P. Morgan had just proven that one man, operating outside any official authority, could command the entire financial system. The question of whether that was a triumph or a warning wouldn't be answered for years. The morning of October 25th, 1907, broke clear and cold over New York City. For the first time in weeks, the lines outside banks were shorter. Not gone, trust doesn't return that quickly, but manageable. The panic was ebbing. The morning papers told the story in banner headlines. Morgan saves Wall Street. Crisis averted by private action. One man stands between America and ruin. For a brief moment, J.P. Morgan was the most admired man in America. Letters poured into his office. Grateful depositors who'd gotten their money back. Business owners whose factories stayed open. Even some of the trust company presidents, sheepish now in the light of day, sent notes of thanks. Morgan read none of them. He was, by his own account, too tired to care. But not everyone was grateful. Within weeks, a different narrative began to emerge. If one man could save the financial system, didn't that mean he also controlled it? If J.P. Morgan could decide which banks lived and died, what did that say about American democracy? The muckraking journalists of the progressive era, already suspicious of concentrated wealth, seized on this question. Publications like McClure's magazine ran exposés with titles like The Money Trust and Morgan's Monopoly. They painted a picture of a man who'd used the crisis to consolidate his power, to eliminate rivals, to essentially become the uncrowned king of American finance. Some of the accusations were unfair, many were overblown, but some carried uncomfortable truth. Morgan had decided, unilaterally, which institutions were too big to fail. He'd forced banks to cooperate whether they wanted to or not. He'd locked men in a room until they signed away their autonomy. He'd coordinated a bailout using private money, but with all the coercion of state power. He'd saved the system, but he'd also revealed how fragile it was, how dependent on the will of a single individual. In Congress, there were calls for investigation. How much power did private bankers really have? Should that power be checked? The Panic of 1907 had proven that America desperately needed some kind of central banking authority, but also that many Americans still feared such concentration of financial power. In 1908, Congress established the National Monetary Commission to study banking reform. It was led by Senator Nelson Aldrich, who spent years examining European central banks and American financial history. The conclusion was inescapable. The United States needed a lender of last resort. It needed an institution that could do what Morgan had done: coordinate liquidity, stabilize panics, act as a buffer between individual bank failures and systemic collapse. But it couldn't be J.P. Morgan. It couldn't be any single person. The debate raged for years. Populists feared that a central bank would become a tool of Wall Street. Bankers feared that government control would lead to political manipulation of credit. Small-town bankers feared domination by New York. Everyone feared everyone else. Morgan, for his part, stayed largely silent. He testified before Congress in 1912 during the Pujo Committee hearings investigating the Money Trust. The confrontation between Morgan and the committee's counsel, Samuel Untermeyer, became legendary. Untermeyer pressed Morgan on whether he controlled vast swaths of American industry through his banking relationships. Morgan's response was characteristically blunt. "I do not control anything." When Untermeyer pushed harder, asking if Morgan's influence over credit gave him power over businesses, Morgan delivered one of the most famous lines in financial history. "A man I do not trust could not get money from me on all the bonds in Christendom." It was revealing. For Morgan, the entire financial system ultimately rested not on gold, not on legal frameworks, but on trust. Personal trust, character, judgment. It was a vision of finance that was already becoming obsolete, even as he articulated it. On December 23, 1913, President Woodrow Wilson signed the Federal Reserve Act into law. It created what Morgan's rescue had proven necessary: a central banking system that could provide liquidity during crises, regulate member banks, and act as a lender of last resort. The Federal Reserve System was a compromise. Not a single central bank like the Bank of England, but a network of regional reserve banks coordinated by a board in Washington. It was designed to prevent the need for another J.P. Morgan rescue, to ensure that private individuals wouldn't have to lock bankers in libraries to save the country. J.P. Morgan never saw it take effect. He died on March 31, 1913, in Rome, 8 months before the Federal Reserve Act became law. He was 75 years old, worn down by years of stress, public criticism, and the burden of being the man who'd held the system together through sheer force of will. His estate, when inventoried, shocked the financial world. People assumed he'd been the richest man in America, worth hundreds of millions. The actual figure was approximately $80 million, substantial, but far less than contemporaries like John D. Rockefeller or Andrew Carnegie. When Rockefeller heard the number, he reportedly said, "And to think he wasn't even a rich man." It was a comment that revealed much about the Gilded Age's warped sense of scale, but it also suggested something else. Morgan hadn't been motivated primarily by wealth accumulation. He'd been motivated by something harder to quantify. Power, yes, but also duty, pride, the desire to prove that intelligence and will could shape outcomes. While historians and economists debated Morgan's legacy, the human cost of the Panic of 1907 was quietly tallied in less prominent places. Samuel Levy, the clerk who'd lost his savings in the Knickerbocker collapse, never fully recovered. He found work eventually, but at lower pay. His family's standard of living dropped. His daughter never went to college. The trajectory of an entire family altered by 1 week in October. Multiply Samuel by the thousands who lost everything when banks failed. The panic had been contained, but not before real damage was done. Morgan had saved the system, not every individual within it. There's no memorial to those losses, no monument to the shop owners who closed, the workers laid off, the families displaced. They were collateral. Damage in a crisis they didn't cause and couldn't control. This is the hidden arithmetic of financial panics. They're caused by abstractions, over-leveraged trusts, liquidity crunches, coordination failures. But they're suffered by flesh and blood, by people who just wanted stability and got chaos instead. Morgan understood this intellectually. His Bible reading wasn't just for show. He genuinely wrestled with the moral dimensions of economic power. But understanding and feeling are different things. It's hard to empathize with thousands of individual tragedies when you're trying to prevent millions more. The aftermath of 1907 left America in a strange position, psychologically and politically. On one hand, Morgan had proven that decisive action by someone with authority and credibility could stop a financial panic. He demonstrated that coordination, liquidity provision, and psychological confidence building worked. Every modern central bank operates on principles Morgan improvised in his library. On the other hand, he'd also proven how dangerous it was to depend on individual heroes. What if Morgan had been traveling abroad? What if he'd been less capable, less decisive, more self-interested? What if his rivals had refused to cooperate? The system Morgan saved was also the system he dominated. This wasn't just a conflict of interest. It was a fundamental philosophical problem. Can you trust your savior when he's also your master? This paradox haunted American politics for decades. It still does. Every financial crisis resurrects the same debate. How much power should we give to those who promise to save us? How do we build institutions that can act decisively without becoming tyrannical? Morgan's rescue in 1907 gave America both a model and a warning. The Federal Reserve System was the institutional answer. Create an official entity that could do what Morgan did, but with public accountability and legal constraints. Whether that answer actually solved the problem is still being debated every time markets crash. Morgan died on March 31st, 1913, in Rome. He was 75, worn down by stress and public scrutiny. 8 months later, the Federal Reserve Act became law, the institutional answer to the question his rescue had posed. His funeral drew thousands. The stock exchange closed in his honor, but even as they mourned, Americans debated what he represented: visionary leader or dangerous oligarch, savior or tyrant. Both were true. Morgan had saved capitalism by proving it was broken. He demonstrated that one man could coordinate what governments couldn't, and revealed how terrifying that dependence was. The Federal Reserve was designed to ensure no single person would ever wield such power again. To systematize what Morgan had improvised, to make rescue predictable, accountable, democratic. But Morgan's ghost haunts every crisis since. The 2008 bailouts, the COVID response. Every emergency intervention echoes his playbook. Coordinate banks, inject liquidity, restore confidence. What shocked the world in 1907 became the foundation of modern finance. We've normalized the impossible. Today, the Morgan Library still stands at 219 Madison Avenue. Tourists admire its frescoed ceilings and rare manuscripts, unaware that these walls witnessed the salvation of American capitalism. There's no plaque marking where Morgan locked the doors on October 24, 1907. No indication of the impossible decision made here. The library remembers Morgan the collector, not Morgan the crisis manager. Perhaps that's fitting. Buildings shouldn't carry history's weight too obviously. But something haunts these halls, the echo of a lock clicking shut, of exhausted men making life or death decisions, of one individual's will bending an entire system. When America faced collapse, salvation didn't come from Congress or the White House. It came from a library lit by gaslight and a man who refused to accept defeat. J.P. Morgan's impossible idea worked. He proved that panic could be defeated by psychology and mathematics, applied with ruthless efficiency. He showed that one person with sufficient credibility could coordinate the rescue of an entire financial system. But his success left a question echoing through every crash since. What happens when your savior is also the system's greatest risk? Morgan wasn't elected. He wasn't accountable to anyone. He acted unilaterally, making decisions affecting millions, constrained only by his judgment and conscience. He happened to be brilliant, dutiful. He happened to prioritize stability over profit, but happened to be is a terrifying foundation for a financial system. The Federal Reserve hasn't fully resolved this tension. Central banks still make judgment calls under impossible pressure, still decide who lives and dies, still use public resources to rescue private institutions. The power is distributed now, constrained by rules and oversight. But it hasn't been eliminated. It can't be. Because financial systems will always be vulnerable to panic, and panic will always require decisive response. Every time the markets shake, we're back in Morgan's library asking the same questions. How much power do we give those who promise to save us? Can we trust institutions more than individuals? What's the price of stability and who pays it? Morgan saved American capitalism, but he also revealed its fragility. He proved it could be rescued, and that it needed rescuing. He demonstrated that concentrated power could do good, and that such power was dangerous in any hands. These contradictions define his legacy. He was hero and warning, savior and threat, the answer and the problem. We remember him now, when we remember him at all, as a symbol of Gilded Age excess, but perhaps we should remember him differently, as a reminder that behind every system are human choices, that stability isn't natural but constructed, that confidence must be earned and can be destroyed. Morgan's library still stands. The Federal Reserve still operates. Markets still cycle between panic and confidence. And somewhere in modern capitalism's machinery, echoes of October 1907 still resonate. The locked door, the impossible idea, the question that never goes away. When the system fails, who saves us? The answer died with Morgan in 1913, but the question endures, waiting for the next crisis, the next panic, the next moment when someone must do the impossible. Again.